We absolutely do think it's a strategy that will remain relevant in the decade ahead and will deliver a lot of benefits amid a world that has a lot of uncertainty. So we can think of geopolitics, tariff uncertainty, inconsistent and uncertain US policy with the risk of inflation over the longer term. We're seeking companies that have a low level of sensitivity to the economy and that can deliver very consistent earnings per share growth over all kinds of cycles and create a portfolio that has a lot less risk than the broader market. And first I'll take a step back and at the overall portfolio level, what we're trying to do is achieve 8 to 10% absolute returns with a lot less risk than the broader market. And to do that, we look for companies that have 4 characteristics. The first one is resiliency or durability. And we define that by a company that doesn't have more than 15% earnings or free cash flow decline in a very difficult environment. The second factor us is value creation. So we're looking at companies that can grow their earnings and distribute dividends to shareholders at a clip of 10% or greater per annum. The third factor is management. So we like to align ourselves with businesses that are run by people who exhibit humility, precision, and have a really excellent track record around operational performance and capital allocation. And lastly, we're looking for moderate prices. So we want to pay attractive prices for these businesses. One is a provider of communication equipment and software for mission critical systems in the public sector. So think about the communication networks for policemen and firefighters or emergency responders. So these are businesses that are not economically sensitive. That spending continues year in and year out. And management of this company has also done a fantastic job of adding related services and taking market share versus the competitors. And by virtue of that, this is a company that has compounded returns for the shareholders of the fund by about 21%. Since we bought the shares at inception of the strategy. A second example is a company that specializes in waste management collection. So, regardless of what the economy is doing, trash has to be collected and has to be disposed of in landfills. This is a business that has tremendous barriers to entry. So year in and year out, they're able to take a decent level of pricing from their customers. And management has done a great job of buying some related companies within their geographies to get more scale and better profitability. One is a UK-based consumer products company which sells health and hygiene products. So think of the products we use to clean our kitchen or the products we give to our children when they have a headache or a tummy ache. So these are products in demand for which really doesn't fluctuate a lot depending on what the economy is doing. We expect this company to be able to grow its revenues 4 to 5% organically every year. And in a recession, they should still be able to grow that number 3-4%. And with a great management team behind the company, that should lead to operating leverage and shareholder returns through buybacks and dividends that we estimate should create about 12% value creation per year. And we're able to buy this company at a great price today, about 12 times earnings, when typically companies of this financial profile can trade from anywhere from 16 to 20 times. The second one is a Canadian insurance company which sells basic insurance products like car insurance, home insurance, basic business insurance. So services that need to be purchased year in and year out. And this company is double the size of its closest competitor, and by virtue of that earns double the level of profitability. So its ROEs are around 15%, and it's able to translate that into about 10% earnings growth over a cycle, in addition to 2% returns through dividends to shareholders. It trades at an attractive price versus the market, and is run by one of the best management teams in our portfolio. And they have a long track record of executing better than their peers and opportunistically redeploying capital through acquisitions that augments that growth beyond what we're currently expecting.
Through it all, the United Global Durable Equity Fund remained stable, standing strong and accompanying you every step of the way. Stay invested, stay durable.